Welcome back to the Deep Dive. You've handed us a fascinating stack of sources this week, charting a truly dizzying intersection. This clash between rapidly accelerating AI technology, surprising corporate earnings, and, well, political policy shifts adding unexpected friction.
That's absolutely the mission today. We're aiming to guide you through this complexity, synthesizing these often conflicting narratives. The goal is really to map out where the economic gains are concentrating, where job cuts are hitting hardest, and how these political frictions, tariffs, gridlock, are shaping things.
And the core tension here is really what makes this deep dive so crucial for you right now. We have this exponential tech acceleration, mostly AI, running straight into unexpected strength in the, quote, real economy. It's creating some real cognitive dissonance, I think, for investors, for workers.
Absolutely.
Okay, let's unpack this. We absolutely have to start with the AI tsunami. The warnings from corporate leaders aren't just theories anymore, are they? They're specific. Tied directly to job cuts. Let's look at white collar first. Ford CEO Jim Farley, warning AI will replace literally half of all white collar workers. I mean, that's just an immense figure.
It really is. And we're seeing the immediate implementation of that. Take Salesforce. CEO Mark Benioff says AI is already handling, what, up to 50% of their workload?
50%, wow.
Yeah. And the consequence, you can't ignore it. It directly led to cutting their customer support roles. That team shrank from 9,000 people down to 5,000. That's not abstract job loss. It's happening now. Big numbers.
What feels particularly tough is the impact on new workers, people just trying to get into the market. There's Stanford research showing entry-level hiring in AI-exposed jobs.
Yeah.
Coding, customer service, basic clerical stuff. It's already dropped 13% since these large language models, LLMs, really took off.
Right. So if you're starting out there, it's a much tougher environment already.
Exactly. And the pattern seems pretty clear across different companies too, right?
It does. You see companies like Palantir aiming for, 10 times revenue growth while also planning a 12% headcount cut. They're basically saying AI lets them do more with fewer people. And Klarna, the fintech firm, they'd already cut their workforce by 40%, citing AI, even before many others really got started.
So it's not just isolated incidents. It's a trend.
A definite trend, a real shift in how companies are thinking about efficiency.
But it's not just the office jobs, the white-collar roles, that are seeing this disruption. We're seeing huge automation advances on the physical side, too, especially in logistics, warehousing, Amazon's new Blue Jay system, for example.
Ah, yes, Blue Jay. That system's significant because it's about consolidation. It takes 3 separate robotic steps and merges them into one smoother, more autonomous process. Pick, sort, consolidate it, handle something like 75% of items in the warehouse for those tasks.
And the numbers behind that are just staggering when you look at the internal planning. Reports suggest Amazon's automation team thinks they can avoid hiring over 160,000 people in the U.S. by 2027 because of this.
That's a massive potential shift in labor demand. Quantified, it works out to maybe 30 cents saved per package. Now, Amazon pushes back, saying that document isn't their whole hiring plan, but the efficiency target itself is undeniably aggressive.
Which brings us to this really critical safety check being flagged by the very people who built this stuff. Here's where it gets really interesting. How can something driving so much economic activity be seen as a threat by its creators?
That is the core paradox, isn't it? You have over 850 public figures, big names like Steve Wozniak, the AI godfathers, Yoshua Bengio, Jeff Hinton signing this statement. They're calling for a global ban on developing superintelligence, basically AI smarter than humans across the board until we know it's safe, until it's controllable.
It's incredible dissonance. The architects are yelling, slow down, potential danger.
Yeah.
Yet, the corporate world seems to be full steam ahead. Look at Meta naming their LLM division Meta Superintelligence Labs.
Right.
While also laying off around 600 people in that exact unit, even while pouring billions into the AI race. The ambition feels totally unchecked, even if it means cutting the jobs of the people actually building it.
And that tension, huge investment clashing with job displacement, that's really the bridge to our next section.
Yeah.
Because you have this disruption in tech, but then you look at earnings outside big tech, and it's surprisingly strong.
Exactly. Let's shift from the tech disruption to the broader market. We have to acknowledge the strength we're seeing in, let's call it, the real economy.
Yeah.
The news focuses so much on the Magnificent Seven tech stocks, but Jim Cramer recently highlighted strong earnings from, as he put it, actual businesses.
And that's a powerful counter-narrative. It suggests the economy isn't just riding on big tech. We saw great results from industrial players. GE Aerospace, strong on jet engines, RTX, doing well with defense systems.
Manufacturing seems solid, too. 3M had great numbers, launching 70 new products last quarter.
70 new products, yeah.
Yeah.
And even consumer staples like Coke, specialized science firms like Danaher, all reporting really positive earnings.
Okay, but wait. If Amazon's potentially avoiding 160,000 hires and Salesforce cut thousands because of AI, why isn't the overall unemployment picture worse? Is this real economy strength just like masking the AI impact for now? Or is something else going on?
That's the million-dollar question, isn't it? These traditional industries are resilient, partly because they're integrating tech too, but maybe more for enhancing physical processes right now, not just replacing office roles wholesale just yet. Look at General Motors. They beat Q3 earnings, definitely.
Right.
But their future's all about tech integration.
Yeah.
They're rolling out conversational Google Gemini AI next year, putting advanced LLMs right in the car.
And the automation plans go further, right? Like the hands-free driving.
Exactly. By 2028, they expect to launch an eyes-off, hands-free system using LiDAR technology, starting with the Cadillac Escalade IQ EV. So traditional industry is adopting really cutting-edge, safety-critical automation. Their profits are getting tied directly to this AI infrastructure future.
Meanwhile, the rest of the tech sector, outside those giants, seems pretty volatile. Netflix shares dropped, what, 10%? Missed earnings. They blamed a tax thing in Brazil, partly.
Yeah, but analysts also pointed out their ad experience is still kind of unexciting. Too much like old TV ads, maybe not driving enough signups for those cheaper tiers.
And then there's the meme stock craziness.
Yeah.
Beyond Meat had that wild ride, up 112% at one point.
Purely a short squeeze. It got added to a meme stock ETF, and its short interest was incredibly high, over 63%. So the price surge wasn't really about fundamentals, just market mechanics pushing out the short sellers.
Even Tesla showed some bumps, missing Q3 earnings per share estimates 50 cents versus 54 expected, though they did beat on revenue.
And whether you're looking at that meme stock froth or the rise of the giants, the key takeaway for investors is this changing risk profile, this portfolio concentration.
It is so important for you, the listener, especially if you rely on standard index funds, that whole set it and forget it approach. Explain what that concentration means practically.
It means your S&P 500 index fund isn't nearly as diversified as you might think. The top 5 companies, NVIDIA, Microsoft, Apple, Alphabet, Amazon, they now make up almost 30% of the entire index value.
30% from just 5 stocks.
Exactly. Historically, you have to go back to the 70s to see concentration like this. It means your standard index strategy is now massively dependent on how these 5 big tech and AI players perform. If they stumble, maybe due to regulation, competition, whatever, your whole portfolio takes a hit.
Yeah.
Much more than it used to.
That's a really stark picture of market risk. Okay, let's zoom out now to our final section, the macro pressures. The policy stuff that's adding friction, adding costs, starting with the Fed. They're expected to cut rates again next week, right? By 25 basis points.
That's the expectation, yes. The second cut since last December. And this is an actionable insight for you listening. Since CD rates and savings yields tend to track the Fed funds rate, savers will likely see lower returns soon.
So the advice is?
Well, if you have cash you're looking to put somewhere safe with a fixed return, you might want to lock in current CD rates now. Our sources noted OMB Bank, for example, offering 4.36% APY on a 3-month CD. Those kinds of rates will probably drop after next week's expected cut.
Good practical tip. Now, while the Feds may be making money slightly cheaper, other government actions seem to be making goods more expensive through trade friction. We saw this with Atlantic Container Line, ACL.
Right, ACL. They got hit unexpectedly by these USTR's Section 301 port fees.
What are those exactly, and why ACL?
So Section 301 fees are basically tariffs the U.S. Trade Representative puts on goods from certain countries. For ACL, it was a technicality about their ships. They use unique ro-ro vessels, roll-on, roll-off, meaning vehicles, big cargo like airplane parts or data center gear can be driven right onto the ship alongside normal containers. It's specialized. But because of that unique combined structure, they got reclassified under these tariffs.
And the cost impact was huge.
Estimated at $34 million a year. The CEO called it unsustainable, flat out, said it might force them to move operations out of the U.S., which would, disrupt a lot of U.S. businesses relying on that specialized shipping.
And these trade tensions aren't easing up, are they? There's talk of more restrictions.
Yeah, serious reports that the Trump administration is looking at curbing exports to China if they're made using U.S. software. That would complicate things further for global supply chains, impacting companies like Microsoft, IBM, many others.
Domestically, that friction shows up as gridlock, too. The current government shutdown, now the second longest ever.
That's right. Stalled partly over Senate Democrats wanting enhanced Affordable Care Act tax credits included in the funding deal. And, a long shutdown creates uncertainty, hits federal contractors, dampens business confidence.
We even saw it play out in agriculture with that beef dispute, pitting consumer prices against protections for U.S. ranchers.
Exactly. President Trump criticized ranchers who opposed importing Argentine beef to lower prices. He argued essentially that they didn't get that his existing tariffs on Brazilian beef were why they were doing well in the first place. It just shows how these policy tools, these tariffs, are used to push specific economic goals, sometimes creating friction within industries.
Okay, so we've covered a lot of ground. The AI revolution speeding up in offices and warehouses, surprisingly strong earnings in the real economy, but also these stubborn, costly macro headaches, rates, tariffs, political fights.
So what does this all mean? I think the synthesis points to not just a dual economy, but one that's rapidly centralizing. Tech is consolidating huge power. Think that 30% S&P concentration in just 5 stocks. Meanwhile, automation is fundamentally changing work across all industries, from highly skilled planning roles down to warehouse logistics.
And the whole AI conversation has clearly shifted, hasn't it? It's moved from what if to tangible job losses, affecting potentially hundreds of thousands of roles right now. Yet, at the same time, the very experts who created the most advanced AI are calling for a global ban on superintelligence because of safety risks. Which leaves us, and you, with a crucial question. Given that maybe the most powerful economic force shaping our future, AI, is also seen by its creators as potentially an existential threat, how should governments, how should we balance chasing those productivity gains against these really profound dangers being voiced?